Are you a real estate investor or self-employed entrepreneur tired of getting turned down for mortgage programs because you don't fit the traditional mold of income and credit and down payment? What if I told you there's a better mortgage program that allows you to buy your house without worrying about all of the standard documentation that you would typically need for conventional or FHA loans? Smart real estate investors are utilizing a DSCR loan, or a debt service coverage ratio loan, in order to purchase real estate nowadays. This program is phenomenal. A DSCR loan is designed specifically for you that may not be posting a bunch of income on their tax returns or may have a little bit too much debt on the back end in order to qualify based on traditional DTI ratios. A DSCR loan looks specifically at the property you are purchasing and how much income it is generating in order to determine if you qualify. Who are these loans perfect for? These loans are perfect for real estate investors, whether you're first time or an experienced investor, self-employed borrowers, anybody with tricky tax returns, or anybody looking to actually take advantage of a mortgage program that doesn't collect a bunch of documentation during the process and they just need something done quickly. How is eligibility for a DSCR calculated? The calculation is based off of the actual income the property is generating, and the formula that you use is taking the monthly rent divided by the monthly mortgage payment. For example, if the property brings income around $2,000 per month in rent and your mortgage payment is $1,600, then your DSCR ratio is going to be 1.25%. Most lenders, when qualifying you for a DSCR loan, are wanting to see at least 1% or higher when getting qualified. Seeing a ratio above 1% means the property is paying for itself, and that's really the only thing the lender is determining for your qualification. Now, there are other qualifications necessary when getting a DSCR loan, and it comes down to your credit score and your down payment amount. Because a DSCR loan has a lot of benefits like no income documents, fast closing process, ability to scale quickly, it does require a higher credit score tier. Typically, you're going to have options above 660. Now, the interest rates get a lot better when you're in the higher 700s in order to see that eligibility or the interest rate be lower based on your credit score. The other thing that you have to be wary of is the down payment percentage. There are lenders out there that require at minimum 15%, but most of the time you're going to see lenders requiring 20 to 25% or more when taking out a DSCR loan. Now, that relates a little bit to the cons of a DSCR loan, because you do have to have a higher credit score, a higher down payment percentage, and make sure the property is actually bringing in income. That's actually what relates with some of the cons with a DSCR, is you do have to have a higher credit score and a larger down payment percentage in order to utilize this mortgage loan. Some common mistakes you'll want to avoid when getting a DSCR loan is related to Airbnb properties. A lot of investors will see an Airbnb property bringing in a lot of income per year, but a DSCR loan is technically only basing off of what the monthly market rent will be, so not what the Airbnb rent would be. So if you're buying, let's say, a cabin in the middle of the woods, that may perform really well on Airbnb, but if you went to go rent that out every month, it would be very, very difficult to actually be at that 1% or higher that a DSCR requires when getting qualified. Want to know if the rental property you're buying qualifies for a DSCR loan, or if you want to compare against the conventional investment purchase, like a conventional 20% down? Drop a comment below or reach out to me directly. If this video is helpful, please like and subscribe. Thank you so much for watching. I'll catch you on the next one.